Good morning, everyone. Happy to have you with us. Hope we will be joined by some more participants during the course of the morning. For today, I'd like to start with the solution to an exercise that I shared. I think it must be 2 weeks ago by now. It was sort of the follow-up of the cashew factory case study, and let's say first step to using the comprehensive financial model that I sent you by email. And then once we've completed that, I'd like to have a closer look at some of the financial analysis steps in financial analysis using the models as well. So starting here. What we had was a case study for electricity production at a cashew processing factory. We had been looking at the technical aspects, and we had concluded that one of the potential options would be to use biomass gasification using the cashew nutshell produced in the factory for production of electricity using a gas engine. Appropriate system capacity would be around 100 kilowatts, and the system would be operated during the operation of the cashew factory. So that would be roughly 17 hours per day, I believe, for 250 days per year. Now, the questions that were defined in the exercise was to determine the total investment costs, including a contingency budget for unforeseen costs, the net present value at the discount rate of 15%, the internal rate of return, and the final question was whether the projects could be considered financially feasible. Now, in order to do this, first of all, what was necessary was to make linkages between the technical model, which you see in the left-hand screen here, and the financial model. So let's say the different tabs in the Excel file. So let's say starting with the investment cost, for example, linking the different items to the different cells in the investment sheet of the file. And one of the parameters was a contingencies rate of 10%, meaning that say 10% of the total budget would be added in order to cover any unforeseen costs. So that would be a first step. Second step, similar, the expected lifespan of equipment and parts of the energy plant would have to be put in the same sheet under the column life, technical life, so that, let's say, the corresponding lifespan would be noted with the different investment cost items. Then thirdly, there is the sheet with the production cost, requiring the first of all the maintenance cost to be linked through. And in this particular case, we've had some crude estimations of a percentage of the initial investment cost as annual maintenance cost. This is a quite common approach for, let's say, first-hand estimations of maintenance cost. So let's say the maintenance of the gasifier would cost per year 5% of $125,000, and if you multiply them and get them in this sheet here, then you get the annual cost. The sheet has a functionality where you can actually define the number of units for each of the items, of the cost items, and define a unit price, so that in the end you get for each year you get a certain total cost for that particular item. In this case, we have the total annual cost already in the sheet, so we just say that there's one unit for each of them, so the two are multiplied and automatically arrive at the desired annual cost. And it goes for the maintenance of the gasifier, for the maintenance of the cooling plant, of the powerhouse, the generator, electrical works, etc. Fourthly, also in the production cost sheet is the operator, it's a labor cost, which is defined in the input sheet as let's say having one operator full-time available. We put that here, and you have a salary defined in the same sheet. You put that here, and then you get your annual cost for your operator. Then we switch to the income side of the project, and for that we have the sales sheet, the sales tab in the model, where we define on the one hand the amount of diesel fuel in our case, which is reduced by introducing the gasification system. And on the other hand, what we had in the input sheet is the diesel price, which is in this case $1.2 per liter, which we put in the sales sheet under product price. And the two are combined, and they give you the financial revenue for each year. Then what we do is we have a look at the financing, and there's a tab called financing here. In this case, we start easily by saying, well, we finance the whole project by the project owner, which is what we would call an equity investment. So we have a look in the investment cost sheet, what is the total fixed investment, and we match that in the financing sheet under investor, and put it in year 0 of the project. So let's say the pre-production period when the project is being constructed. And then we also check in the next sheet, the financial planning sheet, to check if the amount of equity, the total amount of financing made available, if that is enough to cover all of the costs. And in this case, we see that the total construction cost of 275,000 is completely matched by the investment made by the project owner, so that the total balance in that year comes to 0. So let's say it means that there's just enough financing available for the implementation of the project. And normally for each type of financing, so even if you would have a part loan financing, for example, where you would have a certain repayment and payments of interest, then in the same financial planning sheet, you can see if that wouldn't result in let's say negative cash balances in the project. Because if that would be the case, then it would mean that the project owner would have to put in more equity, more investment from his side in order to arrive at least 0 cash balance. Then we continue to the profit loss sheet, where we fill in the tax rate. I put it at 20% at this point. And in the sheet for the discounted cash flows, we link the discount rate, which is 15%. Now then we have a look at the questions that were defined in the case. The first question being the total investment costs. Well, we look at the sheet investments and we see that they've all been nicely summed up, and the total is 250,000 for the equipment and the installation cost and transport cost and everything, plus 10% contingency budget. That means that the total fixed investment costs are $275,000. So that is the answer to question 1. Numbers 2 and 3, the net present value and the internal rate of return, and both are calculated in the returns sheet, which shows the calculation of the discounted cash flows using the discount rate that is defined in the input sheet. We arrive at a net present value of $36,297 and an internal rate of return of 18%. Those are the answers to questions 2 and 3. And then the fourth question is: it's the project considered financially feasible? In principle, having chosen the discount rate of 18%, of 15%, and the internal rate of return being higher than this rate, it means that you have a positive net present value, and as such you could conclude that it's feasible. At the same time, it's important to realize that the IRR is not that much higher than the discount rate. So it's possible that if there's any variations in the parameters or the variables used in the model, could cause the NPV to drop, or the IRR to drop, and to fall below the discount rate. It's important to have a closer look at what would be the consequence of small variations in any of the variables or parameters, to see if there isn't a large risk of the project becoming, let's say, less attractive if in case of changes in the diesel price, or let's say any sudden increases in the investment cost, for example. Secondly, it's important, let's say, the test of comparing the IRR with the discount rate is one option, but another option is to use the IRR and compare it to other investment opportunities for the project owner. For example, he could extend the capacity of his cashew processing factory, which could have, for example, a higher internal rate of return, and that would mean that perhaps he would be better off investing his money in that project rather than the energy production. So let's say the discount rate versus IRR test is one way to look at the outcome of the financial analysis. Another is to compare to other opportunities. And finally, what could be considered is to look at alternative means of financing, for example, subsidies, grants, perhaps bank loans at attractive interest rates to see if the rate of return on the invested capital can be increased, so that the total amount of equity to be invested by the project owner can be reduced, so that the return on the rate of return on the investment could increase. We'll have a look at that in the next part of today's session. So that's it. I don't know if there's any questions on this. Also feel free. Of course.
I have one question. Thank you for the presentation.
Okay.
Yeah, the access to funding is, in my opinion, one of the biggest struggle for entrepreneurs in Mozambique. So I know it's a bit outside of the scope of this presentation, but most of the projects bring finance from outside, from banks or institutions that give loans at reasonable rates. Is there, what do you suggest, for example, for the rates to be more, it's impossible to do a project when the interest rate is above 15%, 20%. That's what is it's ongoing in Mozambique. So what would be your suggestion from experience in your country to kickstart the economy in renewables?
Well, I believe it's a problem that you see all over, and especially in Africa. I think in most African countries, commercial bank loans are let's say difficult to obtain in the first place, and especially for let's say some types of renewable energy projects where banks are not so familiar with this line of business, which leads them to be risk aversive and either not give out loans at all, or if they do, then like you say, give them under very high interest rates. I think it's tricky, and like you say, it's not really my main area of expertise, and I don't really know the situation in Mozambique very well. There's this very generic things that can be indicated, like, well, on the one hand, it helps if you are able to secure grant capital, because with grant capital you can increase the return on investment for the equity investor, making it possible, or let's say more likely at least, to attract loan financing. Let's say if you have a project, for example, with an IRR of 20%, then it might just be possible to use bank loan of, let's say, 15% interest. But if you have, for example, 25 or even 50% of grant, then it becomes much easier on the one hand to obtain a loan in the first place, because banks they will want to limit their position in a project to a maximum of, well, 50%, 2/3 maybe. Less.
Yeah, I think that's a way to go. That's what many organizations are doing, is to maximize the access to grants in order to, Okay.
This
Thanks
is
a
of
lot.
course,
Yeah.
and this is of course not a, let's say, a situation where you want to be if you want to develop a commercial market. But I think that's let's say for the short term, this is the
Yeah.
the
But
actual.
yeah, thank you. I think that's it takes longer. It takes you sometimes to ways that you don't want initially to take because it has conditions and yeah. But yeah, it's one way.
Okay, I would definitely advise you to participate in Wednesday's session, because let's say there's going to be some discussions also with people from Get Transform.
Yeah,
they are
thanks,
more,
Bart.
yeah.
Thanks.
Okay. So okay, we'll be switching to the next presentation. All right, so the next part of today's session, I'll be looking at some in more detail in some financial analysis methods and some additional issues in the financial modeling. Pointer back. We'll, after a very short recapitulation of some of the things that we looked at during earlier sessions, we'll have a quick look at net working capital, what that means, production costs, and how the development of production output of your project, how that affects the financial position of projects. We'll look at the levelized cost of electricity. Have a look at discount rates and selecting a proper discount rate. We'll look at inflation, how to include that in financial analysis. We have a quick closer look at financing, looking back at the remarks and the question of Mr. Kamal. And finally, we have a quick look at sensitivity analysis. Recapitulation. Very quickly, we have during the previous session looked at the financial model that I shared with you also for the case study exercise. We saw that we have different sheets, a few input sheets where you you input the information coming from, let's say, for example, your technical model and your sheet with parameters, and that on the basis of these inputs, let's say different other sheets are calculating, for example, the results, the cash flows for discounting, the balance sheet, for example, and calculating the financial indicators. So it's all linked together, and once you manage to make the right connection between your technical input sheet to the let's say the sheets in the financial model, then let's say the whole calculations let's say complete financial calculations are carried out by the model itself. Now, one of the parts of the model that I've not looked into yet was the net working capital, even though working capital is really needed in order to carry out a project, because it's basically, you know, the funds that you need, let's say, on top of your investment in equipment, in fixed assets. You need to have some funds to start operating. You will have some operators. You will have some consumables. Depending on the project, this could be you know, some small materials. This could be actual fuels, lubricants. It could be as simple as some stationery. You need to buy this in advance before you actually start producing. On the other hand, if you start producing, you start producing electricity. It will take a little while before you will start receiving income. This could be one or several months before, let's say, the first bills are being paid. So you also need to have some funding to cover this period, and not immediately get into very severe, very real cash flow problems. So that's why you need to have some working capital. Now, the working capital requirements are calculated also in the model, on the basis of, let's say, the inventory in the project. And again, this varies per project. In the case of a bioenergy project, for example, this could include a certain stock, include spare parts. This would include like I said, lubricants, those kind of inputs for running your project. What they call accounts receivable, being the payments for products or services delivered, which will start coming in after one or several months. Accounts payable being exactly the opposite. Let's say all bills that you have to pay, you don't have to pay them immediately, but you have a certain due date. So let's say, instead of paying immediately, you can, similar to your own clients, you can say, well, we pay them after a month, after 2 months, depending on what is agreed with the supplier. And the fourth element in working capital is the need for having petty cash. Let's say small amounts of cash that you need to, you know, to make small purchases, that you don't have to pay them from your own pocket, from the operator doesn't pay them from his own pocket to be reimbursed later, but just have a small cash register where some cash can be taken from if small purchases have to be made. And basically what you do is you add up everything where you need working capital for. So that's for buying your initial inventory. That is for having some additional funds for covering the accounts receivable, having some small amounts of cash, some small amounts of petty cash. If you add that up, you get the working capital that you need for operating. Also call you the current assets. And what you then subtract from this amount is the accounts payable, this amount, and then what you end up with is the net working capital. Now, calculation of these different elements is done on the basis of the number of months coverage. So let's say accounts receivable, for example, if you say, well, it will take a client, let's say on average about 2 months for him to pay his bill, then you use a coverage of 2 months. On the other hand, if it's a project in a company where they replace let's say energy or let's say fuel use in a generator, then accounts receivable could actually be low or non-existent, because it's an immediate saving, and it's an, let's say, internal crediting. Accounts payable and inventory are also based on the number of months to be covered. Accounts payable on the basis of the operating cost, so everything that you have to pay, from let's say the salary of your staff to any purchases that you have to make for functioning of your project. It's all to be included in the accounts payable calculation. And for the inventory, you look at the, let's say, the coverage of everything that you need as production inputs. Let's say the physical inputs that you have to have ready to start producing on let's say on day one. Cash in hand is usually a small percentage of the inventory and accounts receivable. And it's important to note that net working capital has to be covered as part of the required investments. So you have to have it available before you start producing, and therefore it has to be there has to be funds available to cover the net working capital requirements. And also, when you start a project, you may have certain working capital requirements, but this can also change over time. For example, if you produce more electricity, then you may have, let's say, larger quantities of accounts receivable needed, because your total sales go up, and let's say the total amount of cash that you'll be waiting for to be paid will be higher than when you are at an initial let's say lower production output. A small example, so if you have a grid-connected gasification project with a turnover of $1.5 million, you have a certain inventory consisting of fuel stock and spare parts and consumables, like again lubricants, and the total cost of the inventory is $100,000. The annual operating cost of the plant are $200,000. How the calculation of the net working capital, if all suppliers will pay within 3 months, and all the expenses will need to be covered within 2 months, and with let's say a amount of $5,000 in cash available for small expenses, Means that you can calculate accounts receivable as 3 months divided by 12 months per year, multiplied by $1.5 million is $375,000. Your accounts payable to be settled within 2 months over 12 months per year, multiplied by the operating cost of $200,000 per year. You have $33,333. You have the inventory, which was defined as $100,000, and petty cash, which was defined as $5,000. Then your total net working capital requirements can be calculated as $446,667. And this is, let's say, a calculation by hand, but as you may see in your financial model, it would be a matter of selecting the right elements to be covered from the production cost sheet, defining the months of coverage needed, and the percentage of cash in hand, and the model will do the rest, let's say, for the initial year, but also for the whole project period. Any questions about working capital? No questions? Okay, then we continue. I think it's important to have a quick remark on production costs. As such, that the production costs as defined in the relevant sheet in the model can be seen as, let's say, the sum of the operating costs and the depreciation and the financial costs. So basically, that's the interest on loans, where the operating costs are based on, are calculated from fixed costs and variable costs. So these are the amounts, the cost amounts per year, and then you can calculate them as a per unit cost in a particular year, and that would be, let's say, the total annual production cost divided by the annual production, and then you get your per unit cost. As this will vary through time due to variations in the output on the one hand, the production, the energy production. On the other hand, you may have varying annual production costs because of, let's say, the variable part of the operating costs, so which change with the production output. On the one hand, on the other hand, the fixed costs, which will be the same regardless of the production. You may get variations both in the annual cost, but also in the per unit cost. So you will see that looking at different years, depending on, for example, how you finance your project, or whether you assume a certain development in the output of your project, you will get a certain development of your per unit production costs. It's important to realize that production costs are not the same as the levelized cost of energy, which is calculated over the complete lifetime, the complete project periods, by discounting the cost and the production output. So we're looking at the levelized cost later on during this session. So mentioning in relation to the production cost, the production output and the development of production output, they have a very large impact on the production cost, and as such they have a large impact on the financial performance of a project. On the one hand, if you have let's say a low project output, low energy production, which could be due to low energy consumption by the clients, you will have a proportionally low revenue. So basically, you know, every kilowatt hour that you produce, you get a certain price, of course, depending on how the total tariff and the total bill for your client is built up. If there's a fixed component and a variable component in this bill, then you may also have some revenue, even if the consumption is low. On the other hand, looking at the production cost, it's only the variable part of the cost which change with the production. So let's say you always have a certain amount of fixed costs, and for some projects where you have especially high investment costs and let's say lower operating costs, then the fixed portion of the production cost may be substantially higher than the variable cost components. So you may have very little variation in your production costs related to the actual output of your project. You see in this graph, for example, you see the production per year in kilowatt hours per year as a function of plant capacity, and you see a production cost which has the fixed component, and due to the variable component, it increases with increasing plant output. But if you then divide the production cost by the production, you see that the per unit production cost, which is the gray line, is really goes up very much if the output of the and the higher the output, the lower the per unit production costs. And that's why it's important to make sure that you choose your plant capacity, for example, as appropriate for the expected demand. So otherwise, your investment cost may be substantially higher than needed, and that could result in unnecessarily high per unit production costs. So the energy production may develop over time. Let's say there could be different mechanisms there. On the one hand, especially in isolated systems, the energy demand could increase by, let's say, different mechanisms. On the one hand, there could be new clients that connect to the system. On the other hand, clients can over time start using new applications and thereby increasing their consumption. And so what you usually see is over time an increase in the consumption. On the other hand, what you could see is the first few years could see a relatively let's say low production because of let's say unforeseen problems during the startup phase, which you may call teething problems, and that can take a while to get sorted out. It could, for example, mean that plant availability is lower than expected, or that it may be needed to detach some part of the load when the system, the generating system, cannot cover the full demand. What maybe another mechanism is a decrease of the system capacity over time. And, it could be, for example, it could be on the one hand because of let's say maintenance issues. If maintenance is not done correctly, then at some point during the project, you may see that the availability of equipment may be reduced. You may see for solar projects, for example, that the efficiency of solar panels reduces over time, especially if you have a system that operates at say peak output. You may then notice after a certain time that the total output could go down, unless, let's say, additional investments are done to compensate by adding additional capacity, for example, additional panels. That is not done, then let's say over time there will be a very slow reduction in the production. Now I had prepared a little poll again, just to see if you're all with me. The figure here, it shows, just start the poll. I think it's self-explanatory. So we see the figure here. I'll try to move it. Oh. That's a bit tricky. Just a moment. Let me see if I can do it better. We see the figure here, showing three demand development scenarios. We have the low startup scenario, that's the blue line, where you have, like explained in the first year, you have some reduced plant output, and after that you will have a continuous production output. If we have a scenario where you have an annual increase, starting from a certain level and then increasing over time with, I believe this was 5 or 10% increase per year. And we have a continuous production scenario. So, for example, you have a factory that is producing at a more or less constant production output with a more or less constant energy demands, which will result in a sort of flat energy demands over time. And the question to you is, which scenario, assuming that's in all scenarios the total energy production over time is the same, which scenario has the highest rate of return? Is that the continuous scenario, where you have, say, a flat line, is that the low startup scenario where you have an initial low output, but then a somewhat higher average output, or is that the annual increase scenario where you have the 5% increase per year? And now I will start the poll. Okay, so you can send in your answers. 3 scenarios: the continuous scenario, the low startup scenario, and the annual increase scenario. Which will have the highest rate of return? Which will be financially the most attractive scenario? What would, if you would have a say in how your energy demand develops, what would be the optimal, you think? I think it's a bit to follow your gut feeling. I think the difference reductions or increases have the largest effect on the rate of return. Maybe I should add that the rate of return, say that the cash flows in earlier years have a larger influence on the rate of return than the cash flows in later years. That will help you in your estimation. All right. Yeah, we still have some. Any more answers? Wait another 5 seconds. 4, 3, 2, 1. All right, thank you. Let us see. Share the results. We say we have an even output, 33% expecting the continuous scenario to be optimal, 33% saying the low startup scenario is optimal, and 33% saying that the annual increase scenario is optimal. Well, let's have a look. I'm sorry, I'm gonna have to give that to you manually. Let's see. Right, what I had calculated for these different scenarios is for the continuous scenario to have a rate of return of 30%. The low startup scenario has the 26% rate of return, and the annual increase has a 27% rate of return. We have another look at the graphs. Close the poll. So basically, what happens is the following. On the one hand, you had the let's say the low startup scenario, which has a, let's say, a relatively higher annual output in later years, but especially in the first years, when let's say the effect of the cash flow on the rate of return is highest, you have a let's say a lower output. So that means that this has a large effect on the overall returns, the rate of return of the project. A sort of similar thing is what we see in the annual increase scenario, meaning that even though it increases over time, which is of course beneficial for the project, it should be kept in mind that this increase over the later years has a smaller effect on the rate of return. So it means that the continuous production, in case, let's say, all total production over the whole project period is the same. It means that a continuous production is actually the better, the most optimal scenario. Of course, if the starting point would be the same, for example, if the gray line would be here, starting at the same point as the annual increase one, then the annual increase would result in a higher rate of return, because then, you know, the total production per year would be increasing, and that would mean that even though the effect of later year higher outputs would be smaller than the output in the first years, in comparison to a situation where the output would remain constant throughout, and at this initial level, say the annual increase would result in a higher rate of return. Any questions about this? Shall we continue with the levelized cost of energy? Okay. The levelized cost of energy, which is related, of course, to production costs, because it is a measure for the total production costs throughout the lifetime of the project. So it includes the average total cost of building a plant, of operating a plant, in relation to the amount of energy that is generated by that plant, all over the lifetime of the project. Now the main advantage of it is that it's just a single number, so a single digit, and that makes it quite useful for comparing different energy production technologies. So, for example, it makes it possible to compare, let's say, diesel-generated electricity with solar electricity at a certain plant scale, for example, or biomass energy, wind energy, etc. Having all different levels of initial investment, different levels of operating costs, different levels of actual production throughout the lifetime, and let's say the levelized cost of energy calculation gives a single measure for each option, making it possible to compare these very different projects, and give an indication of what would be the most cost efficient one. Now the levelized cost of energy is calculated by calculating the present value of all the costs during a project. So it includes the investment costs, the initial investment costs, and also reinvestment costs at different points of the lifetime of the project, if any. And if we say present value, we are of course talking about the depreciated, the discounted cost, and let's say all the discounted costs during the project period, and we divide it by the present value of the energy produced, and this is also discounted. So basically what you get is, let's say, the sum of the discounted cash flows of all the years divided by the energy produced in each of the project years discounted, and you divide them, and that's how you get to the levelized cost of energy. What can furthermore be done with the levelized cost and methodology is to calculate it for, let's say, the complete cost of a project, and let's say all the costs associated with, for example, the production, distribution, and fuel, etc., to arrive at a single number. What can also be done is to use the methodology for calculating different cost elements of the production. For example, if you have a project that includes both the energy production and the distribution, for example, in a mini grid, and you can calculate the levelized cost of the generation part and of the distribution part. You can see what is the contribution of the distribution cost to the total levelized cost. At the same time, you can have a look at what is the influence of the capital, the investment in the total cost, and what is the part of the operating cost. Let's say for projects that have let's say high investment costs upfront and lower operating costs, like solar systems, for example, or especially also hydro plants. You may see that by far the largest component of the levelized costs are related to the investment, and only a small part would be related to the operating cost. And you would see that for let's say a diesel fueled system, this would be the other way around. So you would see that you would have a very small investment part and a very high costs associated with operating, especially because of the fuel. And that is also another option. If you would take apart the different components in the operating cost, you could have a look at what part of it is related to fuel, for example, and what is related to let's say other parts, let's say the maintenance costs or the staff costs, or well, those being, say, major parts of the operating costs. Now this is what you could see by looking at the levelized costs and how they are built up. I made some calculations for a, let's say, diesel fueled plant and a gasifier plant using a gas engine, and a gasifier plant that operates in dual fuel. So let's say having a diesel engine and having part of the energy produced by producer gas and part by diesel fuel. Let's say under these conditions of operating hours, of loading rates, which result in certain production output per year, and at certain levels of diesel price, biomass price, and a discount rate, you would find such a figure. I think it's quite similar to one of the figures that I saw in Dr. Aranz's presentation last week, where he compared different production scenarios in different mini grid production systems as well, showing the potential fuel costs, capital costs, and say other operating costs. Now I have another poll, and which is also related to this figure here. It's a bit tricky because I hadn't anticipated on the polling screen to come over the graph here to see to what extent that is the case. I'll start it. Let's see. Again, completely over the. Let's see if I can change the screen. We're going to do this. Just try to this one again. No. Okay. Well. Yeah. I'll do this. Well, maybe you can have a look at your downloaded presentation. I don't know if you have that on your laptops, so you can look up the right page showing the figure for the base case diesel and gasifier and dual fuel scenarios. And the first question in the poll would be, what happens to the levelized cost of energy when the diesel costs increase? So we have these three scenarios, one with the diesel generation, one with the gasifier generating the energy, and one with the dual fuel output, the dual fuel configuration of the gasifier and the diesel. The question is, what happens to the levelized cost of energy when the diesel costs increase? So option A is the levelized cost for energy of the diesel case increases. Option B is the levelized cost of energy of the gasifier case decreases. And option 3 would be the levelized cost of energy of the dual fuel case decreases. So the diesel levelized cost increase or the gasifier costs decrease or the dual fuel cost case decrease. Okay, votes are coming in. Give another 5 seconds. 4, 3, 2, 1. Okay, good, thank you. We have some last minute votes. Very good. Okay, so what do we have? We have share the results. We see that more than 3/4, 77% indicates that the levelized cost of energy of the diesel case increases. 15% 2 votes for decrease of the gasifier production cost, and 8% indicating that the dual fuel case decreases. Let's have a look. So this is what actually happens. On the left hand, you see the original base case graph. On the right hand, you see what happens when the diesel price increase. And what you see indeed is that the levelized cost of electricity for the diesel case increases from, let's say, just below $60 in the base case to about 67 cents per kilowatt hour in the scenario where the diesel price increases. We see that the gasifier option, which was about $0.52, remains at $0.52 in the modified scenario. Let's say there's no diesel consumption, so even if the diesel price increases, it does not affect the production cost or the levelized cost of generation of the gasifier option. What we do see is that the gasifier dual fuel scenario, because it does consume some diesel during its operation, is slightly affected. Let's say from about $0.54 per kilowatt hour, it would be roughly $0.57 to $0.58. So it's less pronounced than the increase of the diesel only scenario, because the diesel consumption for the dual fuel option is smaller than for the diesel only case, but it's still an increase. Now we have a second question, second poll, and that is: what happens to the levelized cost of energy when the number of operating hours increases from 2,500 to 4,000 hours per year? So instead of 2,500 hours, we operated for 4,000 hours in a year. The effect on the levelized cost of energy. Does it mean that the levelized cost of the diesel case increases? So the cost of the diesel case will be higher. Does it mean that the levelized cost of the gasifier case decreases? So we get a lower levelized cost of production for the gasifier case? Or does the levelized cost of the dual fuel case increase? So we have two options with cost increases, the diesel and the dual fuel. And we have one option for a cost decrease due to an increase in the number of operating hours. It's a bit of a tricky one. It takes some thinking. So it's important to look at the cost structure. What do you expect to be the main fixed cost and main variable cost items, and what happens to the calculation? So you have, on the one hand, you have the cost, on the one hand, on the other hand, you have the production side, which influences the levelized cost calculation. All right. So we close the poll in 5, 4, 3, 2, 1. Okay, we close the poll. Okay, I'll share the results. So the results, we have votes for the increase of the diesel cost, the diesel production cost, levelized cost, and we have equal votes for the decrease of the gasifier cost. We have some votes for an increase in the dual fuel case production cost. We'll have a look. So that's what we have in this sheet. We show the effect of higher operating costs. It's 4,000 hours per year instead of 2,500. Now what happens in all the cases, the production costs decrease with higher numbers of operating hours. We see that the diesel case from about $58 goes to about 55, so there's a very slight decrease in the diesel cost. On the other hand, the gasifier production goes from 52 to 37, so that's a substantial cost reduction. And we see that the dual fuel option goes from 54 to 44. So it's also a reduction, although less pronounced than in the gasification option. Now, what happens here is that because of the extension of the number of operating hours, we see that the plant output, so the amount of kilowatt hours produced in a year increase, and also the production costs will increase. But the let's say the operating cost is only part of the production cost. So let's say the increase of both are equal. But what is not affected is the capital components. So let's say the capital cost on a yearly basis is the same, but because you divide it by the plant output, which increases, the overall goes down. Now this effect is more pronounced for the options which have a higher capital component, and that is particularly the gasification case and to some extent the dual fuel case. So you will see that the let's say the fuel component and the operation and maintenance components are more or less the same between the two options. You'll see that the capital component is smaller because you make more intensive use of the capital goods, of the fixed assets, and are covered by the investment. And that means that per unit of production, the costs go down. So if you have a small capital cost part in the production cost, the reduction will be small. So you see, for the diesel cost, it's relatively small, the reduction. But for the gasifier case, where, as I say, most of the costs are made up of the capital cost components, reduction in this has a much larger effect on the overall cost than in the diesel case. And again, with the dual fuel case, it's somewhere in between. So there's still a reduction, but it's less pronounced than with the gasifier case. Now I have another poll because I think it's interesting. And that is a question: what happens to the levelized cost of energy when we change the discount rate from 15% in the base case to 10%? So, as indicated, we have an influence because we use the net present value of the cost, and we use the net present value of the plant output, of the kilowatt hours produced. So there is we use the discount rate in the calculation. The big question is, how big is the influence of the discount rate, and is it equally pronounced in each of the three scenarios? Does it result in an increase of the levelized cost of the diesel case? Does it result in a decrease in levelized cost of the gasifier case? Does it result in an increase of the levelized cost of the dual fuel case? There's two options where it says it increases. There's one option that says it decreases. Or does it affect the three options in the same way, or is there a difference? All right, I'll be closing the poll in 5, 4, 3, 2, 1. Okay, I will be ending the poll. And share the results. So our results are in. We have an equal number of votes for the increase in the levelized costs of the diesel case, and of the decrease of the gasifier case, and of the increase of the dual fuel case. Let's have a look. Is the correct answer? So we see that there is a very small decrease of the diesel case from the 58 to, let's say, 57 dollar cents. For the gasifier case, we see that we had 52 cents, and we go down to 45 cents. And for the dual fuel case, we go from 54 cents to just about 50 cents. So here we see that the gasification case is most affected in a positive way by the lower discount rate. That's because it's the effect is higher. Let's say the effect of the discount rate is higher on options with high fuel cost and operation and maintenance components. That means that the levelized cost of options with a high capital component, let's say the gasification and the dual fuel option, will reduce further because of this change. I'd like to share a final graph. And that is if you have a, let's say, a more pronounced combination of say improved operating conditions. For example, if you have an even larger number of operating hours and there's a higher loading rate as well of a system, so that's you really get a substantially bigger larger output of your system. And you can see that in relation in comparison to the base case, you can really get very much lower production costs in comparison to diesel generation, for example. And this is of course very much caused by the very big influence of the fuel cost in the diesel generation, the diesel variation scenario, because these diesel costs, they're, let's say, they stay the same per kilowatt hour produced. Even though, let's say, at higher loading rates, you may get a higher efficiency of a diesel engine. You will see that the effect on, let's say, the levelized cost for a gasification project will be quite severe, and that is again because the utilization rate of the system is increased because of the higher number of operating hours and the higher loading rate of the system, which result in say a relatively smaller capital cost component in the levelized cost. Any questions about the levelized cost? Any questions? All right. Well, then we have a look at the discount rate, which is of course an important parameter when we look at the calculation of the net present value and the levelized cost of energy. Discount rate is of course the rate which we use to discount, so to decrease the value of future cash flows, future cash sums generated by a project, in order to value them at let's say today's value, let's say present value. So if you have a higher discount rate, then that means that the value of cash flows in the future from let's say today's perspective will be lower. Then when you have a let's say a lower discount rate. Now, choosing a discount rate can be a bit of a tricky thing. It's important to realize what makes a discount rate. What are the factors that should be reflected by discount rate. On the one hand, that is, let's say, from the point of view of an investor that puts in, let's say, equity and capital in a project, and he wants to have a certain return on this, and any investor will have his own particular minimum rate of return on the money that he puts in a project. That's one. That would be a sort of a bottom, let's say, what they could call a let's say a hurdle rate for an investor. The second point is what alternative investment opportunities exist. So what else could you do with the money that you have available for investing? For example, you could perhaps put it in a bank account if there's any interest that you can expect there, and that might be an alternative opportunity. Even though in practice it can be quite small returns. You might also be able to invest it, in another projects. You could use it for buying shares in other companies, for example, which will also give you certain potential returns, and those are all alternative uses of your capital, the capital of the investor. The third option would be what is the actual total cost of the investment of the capital that's being invested. So let's say if you need to finance a project with parts bank loan and parts equity, then each component of the financing mix will have its own minimum return. It's its own, let's say, percentage of return. That means that you can calculate what it costs to finance a project. That means that this could be seen as a minimum rate of return of the project. But if the rate of return of the project is below that, it means that you won't be able to cover the cost of the invested capital. And of course, the discount rates will vary between countries and between projects. Let's say countries will have their own investment climate, their own specific risks perceived by investors, by banks as well, and projects will have their own, let's say, project-specific risks. Depending on which sector they're invested in, for example. What type of technology is used in the project? Well, this is let's say considered say commercial, or if it's let's say pre-commercial, when it's in a demonstration phase. This might lead to a higher perceived risk of a specific project that makes use of that particular technology, for example. And we'll have a look at the effect of inflation on the discount rate later on in this session as well. Now, one option of choosing a discount rate, which is relatively easy, is to use the weighted average cost of capital. That means if you look at what would be a so-called typical financing mix for a project, It could be, for example, 60% loan and 40% equity. That means that that you could calculate your weighted average cost of capital on the basis of the required returns and the amount, so the relative amount of the relative extent to which that source of capital is found in the financing mix. A weighted average cost of capital for these figures, for example, would be say with 60% loan at 12% interest rate and 40% equity with a desired minimum 25% return on capital. You could calculate a weighted average cost of capital of 17.2% in this case. Of course, if the interest rate would go up, that means that the weighted average cost of capital would be higher. If there would be, let's say, less bank loans, let's say maybe a maximum of 50%, then again the relatively lower cost of loan capital would be reduced, and the required amount of equity capital would be increased, which would also affect the weighted average cost of capital. So there's some bandwidth as long as the chosen values can be justified. Then the calculated average cost of capital can be justified. Important to note is that the discount rates for calculating a project net present value and the discounting rates for calculating the NPV on equity can be different. On the one hand, you know, your project may have to be able to generate enough returns overall to, let's say, for example, to cover the capital cost. But for a certain investor, a certain investor may have a different risk position in a project or risk perception, and he may have a different. He may use a different discount rate. For example, we see here that let's say a 25% return on equity would be normal, for example, for a certain project in certain conditions. That means that this would have to be met for a particular investor, whereas for the project as a whole, the 17% would be the discount rate to be used. We'll have a quick look at that later on as well. It should be considered that even for different investors, you may find different discount rates. So one investor could have a different risk perception of a certain project. For example, if the project is implemented in a factory, for example, the cashew factory, then the owner of the factory may have a different perception of the risk of, let's say, the number of operating hours or the energy demand or the fuel availability. Then let's say another investor that comes in to let's say co-invest in this project, but who may not have the difference, who may not have the same appreciation of the certainties and the uncertainties in the same project. So that might result in the investors looking at the project in different ways, and that might result in different discount rates being used. I don't know if you remember the poll that we had 2.5, 3 weeks ago, where I asked you what you preferred, having, let's say, the $100 right now, or the $100 or a higher amount a year from now. What we actually did there was determining the weighted average cost of capital as required by you as a group. So let's say for some people said, well, you know, I would prefer to have $100 in the future. That was 37%. So 37% would say, well, I would rather have the $100 in the future, which is the same as the $100 at present. So that's a 0% rate on this $100. There was a percentage that said, well, you know, I would prefer to have the $110 in the future over the $100 today. That was about 13%. So that would say they would have a preferred rate of 10%. 7% of you who had a preferred rate of 20%. 14% of you had a minimum of 30%. And by combining all of this, we arrived at a total of a weighted average cost of capital of 21%. By multiplying the percentages with the total share of participants that's to require this rate, and by summing them up, you arrive at the weighted average cost of capital of 21%. Another option for choosing discount rate is to start looking for reference values. By looking for this, I found a survey document. Let's see, the date is incorrect. I'll correct that later on. Let's say giving indications for two different types of technology in different countries, showing indications of discount rates for the project as a whole, which you would call unlevered, and for let's say a particular equity investor, that would be what I call levered. We'll come to the difference in a later stage. What you can see, for example, is that apparently, let's say the general rates in South Africa are somewhat lower than in Kenya, which would indicate that the perceived risk of investment in South Africa is would be lower than in Kenya. And similar thing for, let's say, different technologies, where that would be onshore wind or ground mounted solar PV, indicating that let's say the perceived risk of solar is apparently somewhat lower than for onshore wind parks. So let's say this could be an option. I mean, this is for other countries. Not sure if similar figures would be available for Mozambique, or whether there's any reference values being used in Mozambique. Is there anyone who could give an indication of what would be appropriate discount rates for energy projects? Anyone from EDM or FUNAI? Private sector, anyone? Okay, well, just
as I know, hello, Bart.
yes, Mr. Vader.
As I know, we do not. Yes, as I know, we do not have any specific rates for energy. Normally, we use the commercial rates for it, excluding the cases when there is a loan by the European Union or whatever, yes, or maybe on World Bank, but normally it is not addressed directly to the private sector.
Okay.
But to the private sector, we only can deal with the commercial rates.
Okay. So basically, you would usually use so the cost of capital in this case, like you said, the bank loan rates as a reference for the discount rates. That would be a typical approach in Mozambique.
Yes.
Okay, thank you. So maybe it's possible that in larger institutions the discount rate could be different. Well, of course, because the source of the investment capital can be different. Like instead of having commercial loans, there might be, Mr. Vader indicated there might be options for getting capital at, let's say, softer conditions, and that might result in, let's say, a different choice for discount rates for appreciating a project. I suppose that is something to be looked at the projects case. Let's say if you have projects where you might see different risks, for example, when it's in certain remote areas where it might be unstable, then perhaps this could be a reason for choosing a different discount rate. And when you have projects that are, let's say, a bit more secure, this could be considerations as well. I see that we're approaching 11 o'clock. We go through the inflation, at least for today, and then maybe the rest of the session we can continue in let's say the next week. Inflation, by definition, is the increase of price levels of goods and services, and it can be caused by different mechanisms. On the one hand, there could be an increased demand for goods. Let's say a higher demand for goods or services would result in people having to offer, let's say, higher prices for the good in order to secure their supply. On the other hand, there might be a short supply of goods or services, which would increase the price. And there's situations in which the monetary policy of a country affects the inflation rates. For example, when a government decides to increase the money stock so that more money becomes available in a country, that tends to increase the inflation. Inflation is inflation figures are usually available in the form of a consumer price index, which is a combination of let's say the price increase, the average price increases of different types of products and services. And in some cases, you can find the price increases, so the inflation of specific groups of goods and services, like energy, fuels, labor, salaries, etc. Or on the other hand, foodstuffs, for example. Found a graph of the inflation rates in Mozambique over the last 40 years or so. Well, just as an illustration of let's say how high inflation rates can get, and let's say how relatively stable, even though it might still hit let's say high rates in particular years. You may find. I think that's even in recent years been different examples of hyperinflation, in which inflation rates of thousands of percent per year can be found. So that's, say, the price of food increase by the day. That's large sums of money have to be paid for very common day-to-day purchases. I think that's maybe in the region. The last example was probably in Zimbabwe some years ago. I don't know if there's any other examples in the last 5 or 10 years. Anyway, inflation and how it affects the financial performance of our project. I've prepared some example calculation using the very early form of the project that we the project model that we looked at during the first it's a modeling session. So if we have a project with say an investment of $1,000, we have an annual cash inflow, say from selling a product of $500 per year. We have a cash outflow from annual operating costs of $400. So you get a net cash flow of this is 200, and the net cash flow would be $300 per year. Now, if you don't have any inflation, that means that you have a fixed. Let's say cash inflows and cash outflows are considered fixed amounts over time. That means that also the net cash flow is fixed. That means that you can calculate a net present value in this particular case just over $500 at a discount rate of 50%. Now, what happens if we factor in inflation? For example, 10% inflation per year. You see that on one hand, the prices of the products that we are producing increase on an annual basis. Every year you get a 10% higher price. That means that every year the total income increases with 10%. On the other hand, the operating cost increase by the same rate. And if you combine this, then you see that the net cash flow also shows, let's say, the 10% increase. The question is, what does this do to the net present value? Here we come to the final poll for today. That is my question to you. What happens to the net present value of this sample project when we add the 10% annual inflation rate to all of the prices? We have three options. First option is there will not be an effect. The net present value in both cases is the same. The second option is the net present value will increase. The third option is the net present value will decrease. What is the correct answer to your idea? And again, if we talk about net present value, we talk about discounted cash flows. So of course we look at the net cash flows in all the years of the project. We discount them for calculating the net present value, including of course the initial investment. All right. Okay. Okay, I will close the poll in 5, 4, 3, 2, 1. Okay, I will close the poll. Right, so what are our results? We have 7% of the participants indicating that the NPV will not be affected by adding inflation. We have a majority indicating that the net present value will increase, and we have roughly 1/3 of the participants indicating that the net present value will decrease. Let's have a look what happens. Actually, the net present value will increase. I'll explain. Basically, every year, let's say starting from year 0, and then every year the net cash flow is discounted and then added, say, to the or I should be indicating the net cash flow and added to the total of all discounted cash flows. So we see here, a constant net cash flow. So every year you have the same amount which is discounted and added to the total. Now what happens if the net cash flows increase from year to year? That just means that every year your net cash flow increases, and of course they need to be discounted. But you know, even the discounted value of a larger net cash flow will result in a higher discounted cash flow. So let's say all these cash flows which will grow over the years are all discounted, but in each year the discounted cash flow or the undiscounted cash flow will be higher, and the discounted cash flow will be higher than in the case that there wouldn't be any inflation. So in fact, the net present value will increase when we include the inflation. The only thing is, what is the meaning of a cash flow when it is subject to inflation? Let's say, isn't the value of a cash flow, a future cash flow, which is higher because of inflation, does it have the same value today? And the answer is no. So let's have a look at what we actually do when we are faced with inflation. Because let's say we can work under the assumption that there will be inflation, and we can actually deal with this in two different ways. The first method is to include the inflation, so that indeed every year the prices of goods and services increase, and then we use what we call a nominal discount rate. So that would be, for example, the weighted average cost of capital, which already factors in the fact that the value of money will reduce over time. Let's say a bank will charge a certain interest rate, which will already factor in the fact that repayments in later years will have let's say a lower value than let's say payments in an earlier year. This is already included. The same goes for what an investor will require as a minimum rate, because he knows that the money he has today that he can invest has a certain value, and he knows that future cash flows, because of inflation, will be worth less, and that is already usually included in his expected return on invested capital. And so that means that if we calculate a weighted average cost of capital, and this is already taken into consideration. Now, what is also possible is to calculate without inflation, so with constant prices, and that means that you more or less factor out the inflation, but it also means that the relative value of these cash these cash flows in the future are so not subject to inflation, so they should be regarded with a higher value, and that means that the discount rate that we would use to value those future cash flows to today's value, to let's say today's value, are actually higher, because they're not subject to inflation, because that's what we factored out. So it means that let's say we're more sure of the value of the cash flow in the future. That means that we apply a different discount rate, and we would call that the real discount rate. And there is formulas for that, where you can determine these rates. You can calculate the real rate on the basis of the nominal rate and vice versa. And what this means, well, let's first have a look. Basically, you could say that the real rate, because let's say the risk of, let's say, lower future cash flows is lower, because we already took out the risk of inflation. It means that the discount rate, the real discount rate that we use, is actually lower than the nominal discount rate. That is one to remember. So if you have a project, say if you have an analysis where you factor out the inflation, then you can use a lower discount rate to value the net present value of the cash flows throughout the project period. The internal rate of return, which is calculated for a series of net cash flows, is not affected by a discount rate. So it just means that if we calculate an IRR with or without inflation rates, we will get different values. But it also means that you have to know and indicate what under what conditions the internal rate of return has been calculated. So, for example, if you use inflated, if you apply inflation, sorry, that means that the internal rate of return that you calculate is what we call the nominal internal rate of return. At the same time, if you factor out the effect of inflation, so you calculate with constant prices, then you say that the IRR that you calculate is called the so-called real internal rate of return. And the two can also be calculated and recalculated on the basis of the inflation rate. So this is a choice. The only thing that is very important is that that you apply this consistently. So, say if you have, for example, a price escalation that takes care of inflation. Let's say if the supply contract for energy to the grid, for example, and includes a clause where the price is increased on an annual basis on the basis of the general inflation rate, and that means that you can include this in the calculation, but it also means that you'll have to apply price increases, inflation, to other costs. So let's say to the operating costs, for example, that you have for producing your energy. You can't, on the one hand, work with, let's say, real prices, let's say inflated prices for the income side, and then use fixed prices for the cost side. That results in let's say faulty analysis. The second thing to remember is that there might be differences in the escalation of prices between certain cost elements or revenue elements. As we see, we can use a consumer price index as a reference for for inflation. So that gives let's say a very average over different products and services supplied in a certain country. It could be that's energy costs, for example, increase at a higher or a lower rate than average. It could be that that salary levels increase at different rates. Could be that, you know, for certain elements like biomass cost, you may have different increase rates, and in those cases when there's really notable differences, it could be good to include the inflation in order to get the correct picture of how this will play out in the financial performance of the project. That then, of course, means that the discount rate to be chosen has to match the let's say the methodology, let's say including the inflation. Means using the nominal discount rate. Final indication in the financial model I've shared with you. You can include indexation of the prices, both in the investments cost sheet, as also in the production cost sheet, and also in the sales sheet, so that you automatically get an increase in the sales price throughout the project. It makes it easier to automatically use inflation if you choose so. Okay, so that's it for today. I think I'll leave it here. It's 11:23 already. Any questions?
Yes, I would like to ask you the following. Here in Mozambique, we also have one variation, actually not too much, but we have got certain variation of the exchange rates. And because we do not have high internal production, in fact, our inflation is highly influenced by the inflate rates, the exchange rate, sorry. And in this case, it's quite difficult we evaluate because also the exchange rates depends of numerous internal and external factors that it's quite impossible to us to preview. And on this case, what do you suggest? Because normally we, in our case, or in my case in particular, I do prefer to consider the exchange rate variation than the inflection in projects and issues like this. What do you suggest on this case? To consider the effect rates, or in our case, because the issues that I mentioned, we may combine it with the exchange rates.
Okay. Well, basically, thank you for this question. It's quite interesting. Basically, if you have a substantial, let's say, dependence on imported goods in your project, then what you can do is to have an assessment of how the exchange rates vary over time, and how the actual prices of these goods vary over time. So let's say, for example, if you import for for example, lubricants from outside, then let's say you could apply a let's say an inflation rate from the country from where it is imported, and then apply the development of the exchange rate to this inflation as well. So let's say if your exchange rate between meticais and dollars or South African rands, for example, you could add this development of the exchange rate to the inflation rate in the country where the goods are imported from, and then arrive at expected price levels of these cost items in the project. And that's the same goes for example for reinvestments that need to be done. For example, if you need to buy a new generator, you need to replace your batteries, and that's typically goods that you import. Then you have a time horizon of, well, it can be more than 5 years. So you may have to, if you take into consideration inflation, then this is something to be considered as well. And in such cases, you may have to look at what price levels have done in the country of origin of these goods, and what the exchange rate between Mozambican currency and the currency in the country of origin have done over the last years. And in that sense, you can arrive at a more reliable inflation rate.
Yes, because also we do have the situation when the price should be kept the price of our sales price should be kept stable because sometimes because the government stipulate this price, but because the influence of the items that can be imported and subjected to the inflate rate, the exchange rates, we'll be in trouble sometimes because we have to keep the price stable in meticais, but our cost or our important goods cost comes very, very high also in meticais as well. And it is quite difficult to play sometimes.
Yeah, well, basically, in such cases, it will have to affect the sales price. It's at some point it's not possible anymore to have a let's say financially healthy project under conditions where your costs increase because of over time because of inflation and or exchange rates, and where your sales price of your product or goods is stable. Then if one is unable to increase with inflation, then it's gonna have to be compensated by a higher start price. It's either that or have some kind of subsidy or whatnot to compensate this, because otherwise the project will start costing money for the investor, and then it will collapse. It won't be a sustainable project.
Okay, Thank you very much.
Okay, thank you. So it's 11:30. Thank you, everyone, and I look forward to seeing you next Wednesday for the session together with Get Transform. And of course, during the next joint session Monday next week. Thank you very much.
Thank you, Bart. Thank you for everyone.
Thank you.
And wonderful.
Thank you.